All right, guys, welcome to our predictions for the 2024 real estate market. Predictions is probably not the best use of that word. We're going to be going over the vision. We're going to be looking at all sorts of economic data, real estate data, all throughout the United States. We'll also look at some buyer and seller profiles and how this might impact you, whether you're a real estate agent or a buyer or seller or investor, or you're just enthusiastic about real estate like a lot of us are. We're going to be diving into numbers here. If you have questions while we're going through this, just type them in the chat. I'll do my best to keep an eye on those as we are going through this. And yeah, if you're watching the recording and you have questions after this is already long done and posted, feel free to shoot us an email directly, or you can write it in the comments on YouTube or whatever it is, whatever platform you're using. Before I dive in, I realize that there's a lot of confusion going on in the real estate world right now. A lot of you have probably heard about this National Association of Realtors settlement that has been made around commissions. And I put together a 36-minute video diving in depth on all things related to that NAR settlement. But I wanted to spend just 2 minutes talking about the major changes, just fast and furious, because it might be on your mind if you're watching this right now, either as a real estate professional or a potential buyer or seller. So let's talk about the two changes. Number one, and now none of this has been set in stone. This has been made through the settlement. It still has to be, I guess, upheld by the judge. But there's basically two major changes that they've decided will take place. The first one is they can no longer offer compensation through the multiple listing service. So what does that mean? It means that sellers cannot offer compensation in the MLS. It does not mean that sellers cannot offer compensation to buyers' representatives. So if you're unfamiliar with what that means, essentially what it means is that, a lot of markets work this way where a buyer would represent, or a buyer's agent would be working with a buyer. They would go show properties listed in the MLS. The MLS would have some sort of commission offered, and the buyer's agent would typically take that commission. And sometimes they would go to their buyer if they maybe didn't have enough commission, or if there was no commission offered. Just for clarity, commission has always been negotiable. And here in the state of Idaho, where I'm at right now, for the last basically 12 years, I've been doing business as an agent independent. I've been doing business about 19 years now, but for the last 12, I have only worked through contracts, which means I meet with my buyer, I show them what I get paid, how I get paid, and they agree to that up front before we ever go tour homes. And that's actually change number two, is you can no longer show properties to buyers without a signed buyer-broker agreement. And the compensation has to be identified inside that buyer-broker agreement. So if you've read the headlines, you might have read, just that, headlines. They're not necessarily 100% accurate. They say, oh, buyers are going to save a ton of money, or buyers no longer have to pay. I don't believe any of that's necessarily true. If you want to go tour homes and you want a buyer agent to work with you, you're probably going to have to compensate them. They might not get compensated by the seller now, which means you might have to actually pay their compensation, which means you might have to have more money up front. Now, I mentioned sellers can no longer offer compensation through the MLS, but sellers can still offer compensation to buyer's agents. That can be handled through negotiations. It might even be handled on agents' websites, or maybe in remarks. There's all sorts of ways that this is going to get flushed out. Long story short, nothing's been definitive. These changes are supposed to go into effect in and around July. One of the things we've realized is that if you are a buyer and you want to buy real estate, and you maybe don't have a lot of discretionary cash laying around, or a lot of money saved up, it might behoove you to actually buy before these go into effect, because the home you want might not be willing to pay your buyer agent. And if you have a buyer agent, you're potentially going to have to come out of pocket to pay them. Uh, I'd love to have one-on-ones with anyone who has questions about that, or anyone on my real estate team, Living Select, City of Trees Real Estate here in Boise, Idaho. We'd be happy to talk to you as a buyer directly on what it means for you and how we can help you through this process. So without further ado, we're going to go into the vision. We get these slides from Keller Williams Realty International. These are put together by their team of economists, and all the slides at the bottom have some sort of information on where they got the information from, so you guys can reference that. I'm going to do my best to help you understand what each slide means. There's a lot of them, so we're going to go fast and furious. Here we go. All right, so the numbers that drive the U.S. real estate market. So we're going to be going over home sales, prices, market volume, inventory, mortgage rates, Treasury spread, whatever that means, and affordability. So this is showing you annual home sales in millions by year. And we have this based on, all the way through 1989. So you can see back in 89, there was 3.3 million home sales. 2005, that was when the market was on fire. There was 7.1 million home sales. You can see we dipped down back in 2008. That was the Great Recession, all the way down to 4.1 million. We actually hit that again in 2023. We hit 4.1 million. And then, of course, you can see that we're projected in 2024 to hit 4.3 million. Why are less homes selling? One of the biggest reasons is inventory, which we'll see here in a little bit. But that's one of the biggest reasons why, and I can talk about reasons why inventory is low. This is showing you home prices annually. So the average home price. Now, everything I'm showing you is national data. So this is not any one location. This is all of the United States, the national data. This is a really cool slide. We're going to spend a little bit of time on it, but this teal line you're seeing, or whatever color it is for you, is from 89 until 2023, showing a 4% average appreciation for real estate, where the trend line would be. And it's really interesting. You remember, that housing bubble from 05, that's when I first got licensed, was 2005. We were getting offers faxed in on our listings that we had. We'd get faxes out of nowhere. They wouldn't even tell us they were writing an offer. The fax machine would go, and I was like, what's that? And it was literally an offer for one of our listings. So there was kind of a frenzy, and that pushed prices up quite a bit above that trend line. And then you can see when the housing bubble burst, if you will, in 07, 08, 09, you can see we dipped quite a bit below that trend line, that 4% trend line. And, hindsight's 2020, you go back to 2011 and 12, I had so many buyers that I was working with that were like, gosh, these prices are too high. But hindsight being 2020, we know 2010, 11, 12, that's when the market was at its bottom. And had anyone who bought real estate back then and still has it is very, very, very grateful. But you can see this trend line just holds true, right? 2020 rolls around. Even with the housing frenzy and prices pushed up as much as they were still below that trend line from 1989. We didn't cross over it until 2021. And then, of course, 2022, we started to see rates creep up. And then 2023, rates have continued to be up. But look at pricing. Pricing is still climbing. It's not climbing as fast as that 4% appreciation, but it's still climbing. We were 24% above the trend in 2006. And as of 2023, we're 9.3% above the trend. And then you can see the projection for 2024 is 398, versus 390. 4% on 390 would be 16,000. So they're projecting 2% above the current numbers. All right, so this is kind of chunking down these certain time frames and showing you what the average appreciation was during that time frame. So you can see from 1990 to 2000, it was 3.9%. From 01 to 05, it was 8.9%. So that was kind of that buildup, if you will, the housing frenzy, right? Why was it going up so fast? Well, back then, there was very loose criteria on, getting credit. I remember the no income, no assets loan. Actually, it's how I bought my second home was no income, no assets, meaning you state your income. And as long as your credit score was a certain amount and you had at least 5% down, you could just tell them what you made. You didn't have to prove it. Obviously, that's going to open up a lot of people. You didn't have janitors, you had sanitation engineers, right? And the stated income maybe varied from what it might have actually been. So credit was loose, lots of homes getting purchased, driving prices up. You come over here to 2006 to 2011, you can see we had a negative 4.4% appreciation. So if we go back, you can see that's this dip right here, right? 06 to 11, that's this big dip. And then you can see from 12 to 19, we averaged 6.4% appreciation. And then you go into that COVID frenzy, the last, 20 to 22, that 3-year window, 12.5% appreciation in real estate. Now, 23 and projected 24 is a total of 1.6% appreciation. All right, so this is just showing you some of the events that have taken place through, this is going all the way back to 1954. You have the Eisenhower recession and the Fed raises rates. What's interesting to me about this section here is there's not a lot of flex on real estate. I think technology has added a lot to the reason why we see such high and low swings on real estate compared to what we saw back in the 50s and 60s. And then we come in here. There was an oil crisis in 1973. We saw stagflation of the mid 70s. That was 11.28% appreciation. Now, inflation on its way to its all-time high. That was in the late 70s, 16.2% appreciation. Now, if you've been paying attention to economics, they mentioned this guy Volcker, that was the Fed chair at the time, having, raising rates to an all-time high. He was committed to stomping inflation in its tracks. And that's where you might have heard your parents or grandparents buying real estate in the early 80s with loans in the 17, 18, 19, 20% range. And obviously that was driving down appreciation on real estate because, it was very expensive to borrow money. But I do want to talk about this inflation at its all-time high, just super fast. There's a friend of mine. He was like, "Hey, Chase, I'm going to sell my house right now." This is a week ago. He's like, "I want to sell my house right now. I want to put the cash in the bank. I want to be ready for the next housing bubble or the next burst. Like I want the market to come down, et cetera." And I asked him, I said, "Well, what do you think is going to happen in the economy?" He's like, "Well, I just think inflation's not done. And I think, it's going to continue to go up high. And so I want to be ready for that." Well, just so you know, the reason why appreciation was so much here is because inflation was on its way to all-time highs. Same thing up here. You fast forward to 2020, 21, 22, we saw massive appreciation. We just went over that 12.5% appreciation in those 3 years. That's because of inflation. So if you're worried about inflation, you don't want to own less real estate. You want to own more real estate because inflation is, or real estate is kind of inflation proof, if you will. When dollars go down in value, it means assets go up in value. So just something to think about. I know that seems pretty obvious, but it might not be obvious to everyone out there. All right. So savings and loans crisis, we had negative appreciation, in the early 90s. Obviously, we had a huge ramp up of appreciation from then until 2005. That was the housing bubble, massive negative appreciation with the Great Recession and the housing crisis. And then we've already talked about the pandemic and, inflation being at all-time highs. So let's jump over to inventory. This is since 2001. You can see the inventory levels. Inventory levels, this dashed line is basically representing balanced inventory. So if you're at that between 5 and 7 months inventory level, you're considered what's balanced. So it's not a buyer's market, it's not a seller's market. You're probably going to have normal movement in real estate prices, so that natural 4% appreciation. Well, why did we have 8.9% appreciation from '01 to '05? It's because our inventory levels were below that balance level. If it's below the balance level, that's considered a seller's market. So when it's a seller's market, they get to demand the price they want, they get the terms they want, etc. Obviously, prices just kept going up and up and up. Then we go over that number, right? We go 2006 all the way to 2008. We had 10.4 months of supply. That's a massive buyer's market. So buyers could come in, they had all these homes to choose from, and prices were basically the sellers were lowering their prices to find a buyer to buy their home. A lot of panic in the market. What are we looking at here? Let's fast forward to today, 2020 to 2023. Inventory is lower than it was in '01 to '05. So pricing appreciation from 20 to 22 was 12.5%. That's pretty obvious. But if we go back to the price appreciation in 2023, we only have 3.1 months supply. We're projecting 1.6%. So what gives here? Why isn't prices going up? Well, it's because of rates, right? The cost of housing has gone up because the cost of money has gone up. And, so right now what we're finding is we have this interesting balance. It is, by definition, in terms of inventory, a seller's market. And there's a lot of pressure on the buyer right now, but they're still meeting demand. And why isn't inventory going up? Well, a lot of these sellers who would want to sell, we talk to sellers every day who want to sell their home and be in something new, and they don't necessarily want to buy with the new rates. So they're just staying where they're at. So they're not adding normal inventory that would go on the market, which means we have buyers, not seeing all the homes they would want to see. But there's enough buyers out there for the inventory that is there, the people that have to sell. And so we're just seeing this interesting balance right now. It's very, very, very interesting. All right, this is mortgage rate perspective since 1972. You can see the average historical rate from 72 to 23 is 7.75%. Now, if you do a little bit more modern, right, from like 1990 to today, the average is 5.98%. And as we sit right now today, as I'm talking to you, mortgage rates are about, for the 30-year fix, is about 6.75%. So we're slightly above that, 33-year average that they have, the newer average. We're below the historical average. This is showing you what mortgage rates have done since 2015. We were in the threes all the way down. If you bought or refied in, sometime between December of 20 and March of 21, you're really happy with your mortgage, 2.68 to 3%. You can see in 23 in October, we peaked. We were in the high sevens. I know some people were getting quotes in the eights, and you see we've actually come down a little bit since then. So we're at 6.75 roughly today. This is an interesting slide, and I want to spend a little bit of time on this. This is what is known as the Treasury Spread. So it's the spread between what you can get a 30-year mortgage at versus what the 10-year Treasury's at. And that's the number one tool for mortgages at 30-year fixed is the 10-year Treasury, 10-year Treasury. So whatever the 10-year Treasury's at, there's always a spread above that that's going to give you your 30-year fixed. And this teal line you're seeing is showing you historically what that spread has been. So back in the early 90s, it was 1.21%. So if the 10-year Treasury was 5, your mortgage would be 6.21. You can see in 2008, when the financial crisis was taking place, the Great Recession, if your mortgage was 5%, you were going to pay 7.46%. Sorry, if the 10-year Treasury is 5%, you're going to pay 7.46%. Well, look at what it is today. At the end of 2023, Q4, you're at 2.85% above the 10-year Treasury spread. Now, the average has been 1.74%. This historical average for the last 33 years has been 1.74%. So what's happening? These banks are worried about a number of different things. They really need stability in the Fed. You know, in terms of monetary policy coming from the Federal Reserve, they need stability in that, so they know what direction mortgages are heading, what direction loans are heading, what direction the Treasury is heading. That will allow them to be more confident in the loans they're making. So until the Federal Reserve gets off this, like, we don't really know if inflation's stomped yet, you won't see this come back down to a more normal Treasury spread. A lot of people are predicting that will happen in June. That's the most recent prediction in terms of when the Fed will make a decision on rates, like actually deciding to lower them. And once they make that decision to lower them, now banks have a lot more confidence in what's taking place. It's not this talk, right? Because it's possible that Fed could actually raise rates again. And if they lowered this Treasury spread, these banks could lose money on their loans. So without getting into super detail, you can Google this and go a little bit deeper, but we have about a 1% artificially high rates because of this Treasury spread. So a 6.75% rate today, if the banks had confidence in the direction of the Fed, it could literally, like that, be 5.75% today. And a lot of experts are predicting that once the Fed makes that determination and they're going to lower rates and they think inflation has been stopped, that's when you're going to see mortgage rates drop very quickly. So even though the Fed might lower the federal funds rate by 0.25%, you might see your mortgage rate come down by 0.75% or 1 full% because of the confidence the banks have in the loans they're making. So sorry to hammer this out so in so much depth, but it's just something we're keeping an eye on. All right, this is the affordability index since they've been tracking it here in the early 70s. So in 1972, 22% of your principal and interest was your percentage of your income. So if you were going to go buy the average home price and you had your average income, it cost you 22% of your average income to buy a home. In 1981, what was happening to rates? Rates were super high, right? 18, 19, 20%. So the percentage of your income needed to borrow money and buy a home was almost 50%. So now that you understand that, we can kind of look at the historical average has been 27%. The average from 2000 to 2023 has been 20% because we've had such a low interest rate environment. Right now in 06, it was 32%. Right now it's 32%. So it's more expensive to buy homes today than maybe it has been in the years past, especially the most recent years. But so much of that's driven by rates. So that's why so many buyers and sellers are rate sensitive right now. That's the number one thing I could say about the real estate market today is the rates are really driving the activity. They're driving inventory, they're driving demand, they're driving everything. So what's happening with the Fed and inflation is super important. All right, we're going to look at GDP, unemployment, personal savings rate, inflation, and consumer sentiment. So the reason we're looking at these markers is there's kind of three things the Fed looks at on where they're going to move rates. So they look at GDP. They want it to be at or above 2%. If it's at or above 2%, the economy is doing very, very, very well as far as they're concerned. The other thing they look at is unemployment. This is just showing you annual, here's quarterly. So you can see what happened in the COVID years, right? Like we had no GDP for 2 full quarters. And then what happened here? That was a lot of COVID checks and stimulus, and the economy was finally opened back up, and people were spending money on anything they could buy, right? Amazon did very, very, very well because you still couldn't really travel or do a lot of vacations and stuff. So people had a lot of extra money from, the helicopter money, if you will, or the government stimulus that came into the economy. And that's exactly what that's showing right there. And then we get into more normal, like after, that's what these 6 quarters right here are all indicative of a ton of money being injected in the economy. I think it's something like 25% of all the money ever produced was injected into the economy in the last 4 years, which is just, and that's why we see this GDP being so high. You come to the most recent quarters, we're at 3.3. That's still very, very, very high, which is not necessarily a good thing when it comes to the inflation side of things. Unemployment. This has been a big driver in inflation as well. The number that they really like to be between is somewhere between like 4 and 6%. If you're under 4% unemployment, that actually can be a really bad thing for inflation because it drives wage inflation, right? If there's not enough employees to go higher and companies are fighting over employees, they might be upping the pay, which you might be thinking, well, people need to be paid more. Okay, I'm not going to argue that. It'd be great if people could be paid more. And if those companies are paying them more money, those companies now have to charge more money for their goods or services, which drives up the cost of those goods and services, which ultimately means your dollar's worth less. So that's why we're talking about unemployment when we're talking about inflation. We need to see some layoffs, to be honest with you. That's what the Fed's looking for, is some real change in employment before they know that inflation's really taken a stop. If they could get this up in the 4.5%, 5% range, I think they'd be really, really, really happy. So this is showing you unemployment monthly, since 2021. I mean, it's just been hovering between that 3.5% and 4% for the last basically, year and a half. All right, this is showing you the personal savings rates. Very interesting what's happened in our country, in the last 60 years or so, 70 years. You can see the personal savings rate was, always in that, basically until the mid 90s, it was always above, 10%. And then you can see from 95 until essentially 2012, it stayed below that historical average of 8.3% since 1959. So not a lot of savings have been taking place. Well, what happened here in 2021? Two major factors. We already talked about the economic stimulus. 25% of all income or all money ever produced in the United States came into our economy in the last 3 years, and people couldn't really spend that money, right? So with 11.1% on the personal savings rate, that's because people couldn't go spend money. You couldn't go do anything. We had the lockdowns. We had all the stuff going on. That was driving that up. And then you can see, of course, the economy opens up in 2022, 2023. People are spending money because there's a lot of pent-up demand. All right, so that leads us all to inflation. All three of those things lead to inflation. So if we're looking at the historical average, or sorry, the target is 2%. They know any economy is going to have inflation, meaning, your dollar, 2% per year, your dollar a year from today, they want it to be worth 98 cents, right? You talk to your grandparents. I remember when I can go watch a movie for a nickel and whatever, right? Like, I feel like that sometimes when back in, gosh, I'm only 40, say I'm only 40. That's not that old, right? I think about in high school, I think in the late 90s, like 99, I just got my car. I went to fill up for gas. It was 95 cents a gallon, which was very low for the time. I mean, it was more like usually like $1.50, $1.75 back then. But 95 cents, I was like, why do people complain about buying gas? And of course, I had never really had to spend money on anything in my life. But I thought it was funny. I had $5, put 5 gallons in, I could go drive around in my car for forever. This 2% target is just a target that they really want to be at. It's not a steadfast rule. It's, you can just see what's actually happened here. This consumer price index, or CPI, the yellow one includes energy and food. The reason why they have one without energy and food is energy and food can be very volatile. So the teal one has a little bit less volatility. And you can see it's never just hovering at 2%. It's above, it's below, it's up and around and all that stuff, right? Well, if you look at, 2020, what happens when they print a ton of money and people are going to spend it? And when those people spend it and there's not enough goods to be bought, the people selling those goods raise the price of those goods, and hence inflation. It's funny because it shows 6.4%. I mean, there was some months where we had upwards of 9% inflation year over year. So your dollar a year ago was worth, a dollar, and now it's worth 91 cents. So it's a real problem if inflation is like the biggest hidden tax there is, because if you're making whatever, $15, $20 an hour, and even if you're not paying taxes, every year you get a full refund back. If your money is worth less, that's a huge hidden tax. And it causes a lot of problems in other countries. You guys can Google some of these countries that have had some major issues with their currency. And these people are fleeing from the currency looking for anything. A lot of the cryptocurrencies, gold, silver, the US dollar has always been strong. In fact, even though we've had this major inflation for our dollar, other currencies have been way more inflated by and large. Our dollar has actually been really strong. So jumping back into this, the latest numbers that we've got is 3.9 to 3.4%. They're still pushing to 2%. That's why they haven't lowered the federal funds rate. Basically, when they raise the cost of borrowing money, people spend less money. Less money being spent, the lower the inflation should be in theory. This is a really cool slide. I don't know if this necessarily helps us with anything related to real estate. I guess it does a little bit. I'll explain. But this one kind of blew me away. I'd encourage you to take a picture, share this with your friends, share this with your family, or pause the video, do whatever you need to do. This is such an interesting slide. So it's showing since 2000 what cost of services have gone up. Hospital services are 238% more today than they were in 2000. College tuition and fees and textbooks, 130 to 177% more. I mean, this stuff just blows me away. You can see hourly wages are 93% more. Housing's only 88% more. So your hourly wages have actually outpaced the cost of housing in terms of inflation. So that's really interesting. And I just thought it was funny. Like TVs are negative 97%. Really, really interesting. I feel like they're giving TVs away these days. So, all right. This is diving into some listings with price reductions. This is just kind of like a little bit of a pulse on what's happening in the real estate market. You can see in late, September, October, November in 2022, rates were actually really high back then too, just like they were in September and October this past year in 2023. And both of those saw a spike in price reductions. So pretty interesting. This is new listings. Now, in 2022, we had 5.4 million new listings. 2023, we only had 4.8 million new listings. This is what I've been, discussing. A lot of our sellers, they want to sell. They want to sell, but they have a 3 or 4% interest rate, and they don't have a need great enough to go get a 6 or 7% interest rate. So they're just sitting put. Or we're seeing a lot of them actually do go buy the new house, but because their rate is so good on their house they're having right now, they're just keeping it and renting it out and actually making some cash flow on that and then buying another house. We'd love to go over any of those options with you. So if you have questions, reach out to a real estate professional, reach out to someone on our team. We'd love to answer the questions for your specific situation to see what works best. All right. This is interesting. You might have been sitting out there thinking, man, I really want to know what's happening in the real estate market right now. When's it going to pop? I want to go back to 2010 and buy all those houses. I finally got money. I'm ready to go. I have these conversations quite a bit with friends, family, colleagues, clients, customers, etc. They're all like, when's it happening? Well, go back to 2008. We had 27% of the homes were foreclosures. This is of the home sales. We had 13% short sales. That means they owed more on the mortgage than what it was worth. So they had to sell it short of what that was worth. So we had 40% of all home sales in 2008 were distressed. Okay, then you can look at 09, 10, 11, right? There's obviously a very large percentage of the homes were distressed. Look at 2023. I mean, it's basically a non-issue. right? People have equity in their homes. And so even if they can't afford it, they're selling it and getting that equity out, and they're able to move on. So we're not seeing this fire sale of real estate like we saw back in that Great Recession. All right, so this is showing you the underwater homes. A nice lead in there for you. Back in 2010, 25% of all homes were underwater. And you look in 2023, it's 1.8%. So if you're thinking like, hey, the bubble's going to pop, all these people are going to lose their houses, I'm going to swoop in and buy real estate on the cheap, when prices come down, I would just argue like the data does not support that. Not at this time. Maybe that could change in the future, and real estate moves slow. It just does. It's not going to happen next week, next month, next year. Like it would take a lot of time to get into that scenario. You can see the historical average is 6% of homes are underwater, and we're at 1.8% right now. So if you or someone is waiting for the bubble to pop, there's not a bubble. There really isn't. And I can go over some kind of like airy fairy black swan type events that could take place. If you guys are interested, put that in the chat. Maybe I'll digress on that, but let's keep going. This is going over credit conditions. So the red essentially means that the lenders are tightening up the requirements to borrow money. So it's harder to get a loan. They raise the credit score requirements, or they make you put more money down, or maybe there's more things that have to happen. The green is loosening. So you can see when we got into that Great Recession, that financial crisis back in 2007 and 8, what'd they do? They said, hey, you want a loan? You're now going to have to actually show us your income, not just state it. You're going to have to actually tell us, not just tell us what you make, but show us what you make. And we might even require more money down, and we might even have your credit score be higher. And you can see that was tightening all the way until 2010. And then prices had came down so much, and a lot of those bad loans and the banks kind of were getting out of that, so they started to loosen that up a little bit. 2020, what happened? COVID. Well, they got really nervous. No one really knew what to expect, so they tightened up because they didn't want to get caught like they did in the past. And then, of course, they realized like, whoa, this is a housing frenzy, so they loosened that up again, and now you're seeing more tightening. And when they're tightening these requirements, another way to look at it is they want to do less loans. That's all it is. So if they used to allow you to get a loan at 620 credit score, but then they changed that to 650, it's taking a number of loans out of the system. So just so we're clear, that's what we're talking about. All right, this is new home starts. The historical average, the long-term average has been 1 million. So it's in thousands here. So it's saying 1,000 per year times 1,000, which would be 1 million. That's the historical average. Well, from 2008 till 2000, essentially 17 or 18, we were well below that historical average. This leads into this inventory issue that we've had. Let's go back here. Sorry. Way back to the inventory. This inventory issue we've had, a big part of it has been this lack of new construction that we've had. When that Great Recession hit, builders, developers, and banks all got crushed. So the builders and developers need money from the banks to be able to build and develop. Well, when that gets turned off, there is no building and developing, right? And a lot of those builders and developers got wiped out because they had so much on the line and they just couldn't move on. And then, of course, because those builders weren't building, a lot of those trades had to go get different jobs. And we just really have struggled to get back up to the point where we could build the amount of homes that we build. There's like a 10-year window. We didn't build 2.5 million homes should have been built, and we didn't build them. That's one of the reasons why inventory is low. Another reason why inventory is low, we've already gone over, is a lot of people aren't selling because they're keeping their rate. Another reason that's leading to inventory being low is Airbnb and VRBO phenomenon. There's millions of homes that are Airbnb that normally would have been either a rental house or someone would have owned them as a single family home. They're out of the market. We have another piece of this puzzle here is the institutional investors. So Wall Street investing in single family homes by the thousands. That's taken a lot of inventory out. And then, of course, we have a lot of immigration into our country. And these people are living somewhere. And I think all of these things are leading to this low inventory environment. And I personally don't see that changing without some sort of dramatic shift in our economy. And, yeah, that's it. All right. That's new home starts. Here's new home sales. So showing you they typically sell 650,000 new homes per year. Gosh, the last couple of years we've been right on that. These builders have not overbuilt. That was a big fear of these builders in the past, is getting caught with too many homes and then having to lower the price and then losing money. That has not taken place in a large fashion like it maybe did in 2008. This is an interesting slide going over debt. And, this goes right hand in hand with that college tuition and books and all that fun stuff. You can see, I mean, the student loan debt in trillions in 2005 was 0.4 trillion. It's 4 times that in 2023. So that's 18 years. It's gone up 4x. That's really putting a lot of pressure on millennials, which is the largest home buying group there is in this market today. They're strapped with all this student loan debt. And yeah, that's put a lot of pressure on the first-time home buyer. And then, of course, you can see consumer debt. The last 10 years, it hasn't changed that dramatically. It really hasn't. I mean, it's gone up. Well, I guess since 2015, it hasn't. 2014, it was quite a bit lower. So this is the household debt service ratio. This is just saying the average household carries about 9.7% of their total income as debt. So these would be like monthly payments, et cetera. The consumer debt service ratio, that would be like car payments, credit card payments, medical bills, that kind of stuff. And then your mortgage, you can see the mortgage debt service ratio per household on average is 4%. I think it's something like 40 or 50% of all homes in the United States don't even have a mortgage. So that's playing into that if you're wondering why it's so low. All right, we're going to go into the world's wealthy and where their money is. This is high net worth individuals. I did the math on this. It's showing in 2022, we had 7.4 million high net worth individuals in North America, totaling 25.6 trillion in wealth. And if you multiply that out, the average is 3.5 million is the net worth. So what do they do with their money? If you look at the most recent years, something that jumped out to Brent and I is that real estate's been a pretty steady part of their portfolio. And obviously, we know 2019 to 2022, real estate values have gone up tremendously. So they had to have taken some off the table. Otherwise, their value would have gone up in that category. And you can clearly see in 2022 here, their cash has gone up tremendously, right? It went from 24% right here to 34%. So the high net worth individuals are getting cash heavy right now. It's the highest it's been since 2008. So that's an interesting thing to take a peek at. That would indicate that they think inflation is probably done. If they didn't think inflation was done, or if they thought inflation was going to continue to go up, they would not want to hold more cash. So back to my story of that friend who said, hey, I want to sell my house because I think inflation is going to go up. It's like, no, you don't want cash if you think inflation is going to go up. And I tend to agree with this group that inflation is maybe not stomped in the ground, but it's definitely not going to go up. Well, in my opinion, it's not going to go up like it had in the most recent years. So this is showing luxury days on market. I deleted a lot of slides that I didn't think fit. I kept this one for one major reason. I kind of wanted to show you we have this market that's kind of the haves and the have-nots. Locally here in Boise, our first-time home buyer market, that under $500,000, under $600,000, our average price in the Ada County area is like $575,000. If you're under $500,000, those homes are selling like hotcakes. If you're over a million, those homes are selling like hotcakes. It's that 500 to a million range that is really struggling. And I'm showing you this because typically the luxury days on market is significantly higher than our non-luxury days on market. But look at what it was in December. I mean, they're only 8 days apart. So we're seeing still seeing a lot of activity with people that have money. And yeah, just something to note. Right? If you're paying cash for a property, you don't really care what the rates are, right? This is luxury listings with price reductions. Not a lot of detail here to go into, but if I was purchasing luxury, I'd probably want to get very specific in the market I'm looking at to see what kind of reductions people take. I have personally seen in Boise that there is negotiation, but there's still a lot of movement. Like there's a lot of homes selling in those, multi-million dollar range. All right, commercial trends. Let's take a quick peek. So office has the highest vacancy rates on record. Rents, obviously, if vacancy's high, rents are going to decline. The most pressure is on non-Class A spaces as tenants move to qualify. So, meaning if like Class A space is like the best space you can get, think of like it's on Main and Main and it's super fancy and nice, right? You would go to Class B, Class C, Class D, whatever. Those would be just lesser quality, locations or amenities or whatever. So if you're non-Class A right now, you have a lot of pressure. There's 2.8 trillion in commercial debt due in the next 4 years, and office is at the most risk. You've probably read in the headlines, you've probably seen it somewhere. We've seen these office spaces have mass exodus, right? Especially with COVID, in these major cities. I know San Francisco gets a really bad rap, maybe rightfully so, but they've seen a ton of companies just leave. I mean, I remember watching someone write a check for like $80 million to get out of a lease because they broke their lease. I can't remember what company it was, but it was in San Francisco. And, the whole work from home thing, you're paying this huge office bill and no one's going to the office. That's a challenge, major challenge. So what these banks do, there's a method they call it extend and pretend. So the note on that office space might have been due in 2021 or 2022, but if they called it due, the person couldn't pay it, which means the bank would have to foreclose and they'd have to take the office back. So instead, what they do is they extend for another 2 years, 3 years, 4 years, 5 years, and the whole pretend like everything's fine. So that's one of those black swan events that could be there. Now, if those banks get hurt badly on the office space, that could tighten the credit up on the residential space. So that's how these things kind of yin and yang with each other. Multifamily, there's a downward pressure on rent because there was a huge surge in construction over the last 3 years. The other thing which isn't written on here is a lot of these multifamily projects, they take 2, 3, 4 years from ground up. So if you're in 2021 and the market's going gangbusters and you start a new project and you base it off of interest rates in 2021 because they have to get a loan, right? And typically those loans, when they're doing the construction, they're usually a floating rate because you can't necessarily get fixed rates. Most of those are floating rates. So if they budgeted rates in 2021 were 3.5%. So if they said, let's be conservative and let's predict 4.5%. Well, by the time they get their project built and they get it stabilized, so they have 90% occupancy and they can go ahead and get a permanent financing on it, the rates are now 7-8%. So if you're at 7% and you were budgeting 4.5%, it doesn't pencil anymore. And so that's another one of those black swan events, in my opinion, that I think is out there. The commercial world, from a financing perspective, is very, very troublesome. We'll go fast here. Retail continuing to transition mixed use and consumer experience oriented spaces. Vacancy rates slightly above pre-pandemic levels. Industrial seen a slight pullback after the surge in pandemic era e-commerce. Rent growth has slowed, but it's remained positive. So industrial is still the best in the space there. This is showing multifamily starts. You can see, I mean, look at this 2022. There was a huge amount of multifamily starts, and the average is 371. Yeah. So you can see we had quite the uptick. This is showing loan delinquency rates in the commercial sector. You know, obviously the Great Recession, we saw a pretty big uptick. The historical average has been 4%. I would predict in 2024, this thing's going to shoot up pretty big. That's my prediction. 2025, I think it'll be well above the trend line for whatever that's worth. All right, this is showing you the National Association of Realtors profile of home buyers and sellers. First-time home buyers in 2022, we only had 26%. So we had the least amount of first-time home buyers we've had in the last 23 years. And again, that's driven by rates and debt. So prices went up, and then of course rates went up. So the affordability went up or went down, I guess. However you want to look at that, it got worse. And so we saw a lot less first-time home buyers. It's interesting to see that 2023, we had 32% first-time home buyers. I wouldn't say that it's improved. I would bet a lot of those 2022 normal first-time home buyers finally bit the bullet and bought in 2023. So I wouldn't get too excited thinking that that's like now we have this new trend. Primary reason for buying a home, I really just look at the top three here. So want to own a home, so the desire to own, looking for something larger, want to be closer to friends and family. Tenure in their previous home. So the median is 10 years. You can see in 2021, the median was 8. I think a lot of people kind of realized that their home maybe wasn't suited for work from home conditions, right? Back in the pandemic. So we saw a lot of people move quicker than they would have. Yeah, so 10 years is kind of what they actually stayed in their previous home. Their expected tenure is 15 years. So you can see people expect to be in their home for 15 years, but they only actually stay in their home for about 10. This is how many weeks they spent searching for a home. 8 weeks in 2020 and 21. That doesn't surprise me because if you saw a home you wanted, you had to buy it right away. And yeah, so it doesn't surprise me that that's where it was. And back in 08 through 12, 13, you had so many homes to look at. You know, it probably took you longer to sift through them all, right? First step in the home buying process, looked online as 41%, contacted a real estate agents 20%, and then looked online about how to buy was 11%, and then the lenders 8%. Information sources that buyers used, 88% used a real estate professional. Now, this is interesting. If you go back to the beginning of this, talking about the NAR settlement and buyers' representatives, I'm a firm believer that a buyer's agent is key. I would never buy a house without an agent in my court. I've been doing this 19 years. I've sold over 3,500 properties, over $2 billion in real estate. If you're coming to me and buying a home directly from me and I am representing the seller, not you, I'm going to win. So I would highly, highly encourage you to get an advocate on your side, someone who's looking out for you. You definitely want to hire a buyer's agent. All right, where buyers found the home they purchased. Internet's 52%, real estate was 28%, and then you got some builders and friends, family, open houses. 89% used an agent to buy, and 5% actually bought directly from a builder or used a builder's agent. So I would say 94% of these people are working with an agent to go buy a home. And, you know, I listen to a podcast. I actually really like it a lot, but I'm going to take a little bit of beef with it real quick because I think people are very confused. So the podcast is the All In podcast, and this NAR settlement came up about, 3 months ago on their podcast. And one of the guys, Jason, whatever, I can't pronounce his last name. He said, hey, the future of real estate is exactly how I bought. I found the seller, some friends of mine were selling their home, and I went directly to them without an agent. I hired an attorney and I bought it. He's like, this is the future of real estate. Well, look, 6% of all transactions in 2023 were done that way. How practical is it for you to go find the home of your dreams by talking directly with every single seller out there to finally find the home of your dreams. I'm not saying it's impossible. I'm just saying for the large majority of people, I don't know, 94%, they didn't buy that way because it's not practical, right? It's just not a practical thing. If you have to relocate to a new city, you don't know any sellers, you don't know anyone. You need to do it in a quick, timely manner, right? It's just so silly. I think the education around this is ridiculous. If you really slow down and think about it, having an agent work on your behalf to go make the biggest purchase most of you will make in your life, it is critical. You're not going to perform a surgery on yourself by watching YouTube and, buying a surgical kit, right? Like, take care of your finances, get a representative. Off my soapbox. All right, this is showing you how many people had a written or oral agreement. It was something like 58%, I believe. And this is what's going to change in 2024 come July. It's going to need to be 100% if you work with an agent. What buyers wanted from their agent: help finding a home, help negotiating, was 23%. If you add both of those up, paperwork, obviously comping the home out. I think the negotiation piece should be the biggest one because, if you're working with an expert, someone who does this day in, day out, full time, sells lots of homes, they know what they can and cannot do. If you want to buy the home of your dreams and you're trying to get $50,000 off, and that's never going to happen because that's not what happens in the market, and then you lose out on that home and you never would have got it anyways for 50 grand less. Like, wouldn't you like to have an advocate in your court saying, hey, this won't work? Like, do you want this house or not? Right. And this is kind of the power that comes from, these things like this could determine your future, where you live and where you raise your family could really have a big impact on your future. All right. How buyers found their agent. Referral, is a big one. Use the agent previously, website. This is interesting. Buyer interviews. This is going to change too. 71% of buyers interviewed one agent. I would encourage you, if you're thinking about buying, interview at least two agents. Please interview two agents. Only 17%. I mean, if we add these up, 17.7, so 28% of buyers interviewed more than one agent. That number is probably going to flip. I hope it does flip. It needs to be over 50%. In this environment, you need to have someone that knows what they're doing. It's more important than it's ever been. Interview someone on the City of Trees real estate team or Living Select team. And then whoever else, your uncle or your neighbors, cousins, brother, whatever, it doesn't matter. Interview at least two. If nothing else, that the person you originally wanted to work with is a good fit for you because you've talked to another person. All right. Most important factors: experience, trustworthiness, reputation. I can send these out if anyone needs these, by the way. Feel free to reach out. We can get these slides to you because I'm going to go kind of fast to try and get us out of here on time. Is real estate a good financial investment? 82% of people believe it is. Is it better than stocks? 54% believe it is. And 34% believe it is about as good. All right. How sellers found their agent. Similar thing, right? They used them previously or they were referred. How many they interviewed. This one I think is interesting. Sellers, of all people, the ones who have been writing checks for commissions, 81% only interviewed one. So if we look at these numbers, 20% interviewed more than one agent. Guys, selling your house is so important. Interview us and whoever else you want to talk to. Talk to two people, at least two people, ideally two full-time agents who have been doing this for a while. So you have an advocate on your side that understands what's happening in the market. What do they want? Pricing it competitively. They want to market it properly, and they want to get it sold within a specific timeline. Reputation is important. Honesty and trustworthiness. Friend or family member. Yeah. Commission, 5%. The commission was important. Knowledge in the neighborhood was 11%. All right. Methods used to sell a home. 89% sold a home with a realtor. 7% of all transactions last year were for sale by owner. And then you have a small portion that are selling it directly to a company, which, by the way, probably leaving a ton of money on the table if you're doing that. Talk to us before you sell directly to a company that's going to be an instant offer. If you see those signs that say we buy houses cash fast, no realtors, no commissions, no BS, I can promise you, even paying a commission, you're going to walk away with more money than you would buying, selling your home directly to those people. Talk to me, and I'll be the first person to tell you, like, damn, their offer's great. Just go with it. I promise you that. All right, incentives offered. 77% offered zero incentives. And this is obviously indicative of it being a seller's market. And then you can see that, we are seeing a lot of the builders offer incentives on financing, et cetera. So, okay, guys, whew, fast and furious. I'm going to move my monitor over here. Thank you so much for hanging out. I didn't get very many questions. I see Tim wants a copy of the slides. We'll put a link out that you guys can go inquire for a copy of the slides. We'll make sure that we get it over to you. You will also get a recording of this. And, this should be on our YouTube at Livy and Selects. So if you want to go to YouTube and type in Livy and Select, you'll see it there. And yeah, I really appreciate you guys joining me. I know there's a ton of data. You can always rewatch this video, and we will get you the slides if you'd like them. I cannot stress enough, now more than ever, it is super, super important to have knowledgeable advocates working on your behalf. We work tirelessly here at Livy and Select and City of Trees Real Estate to make sure we're staying up on what's happening, not only in the national market, as you can see, but also in the local market. We have so much more data here locally. So if you are a buyer or a seller or an investor, or you're just a real estate agent and you want to surround yourself with other top real estate agents, reach out to us. We'd love to work with you on your journey. Thank you guys so much for watching this. Have an amazing afternoon.